Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today's analysis is for Friday, February 2nd, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What a day it was out here on Friday. So the market took a huge haircut in comparison to what it's been trading for the last year and a half or whatever the amount of time is. We haven't seen a correction this large in quite some time. So let's discuss exactly what's going on and what we can have as our expectations going forward. So the market was down almost 2.5%, 2.41% on the Spider, 2.12% on the S&P 500. The Dow was down 2.5%. The transports were down over 2%. The broker-dealers were down close to 3%. The NASDAQ composite was down 1.96%. So across the board, it was a heavy sell day. So what we normally look for the beginning of corrections like this is a reversal day. We never got a bona fide reversal day at the highs. And that's a little bit of a shame because with a reversal day, it gives us an opportunity to hop on the downside of the market if we're interested in being short the market and riding it down for a nice, healthy sleigh ride. Well, the market didn't really give us that opportunity unless you were able to hop on today and took the ride down in a one-day big, large sell-off. So that being the case, it's very difficult to short a market that's down this much. What you'll notice is there are three horizontal lines on the screen. I want to address these for a second, and then we'll get back to what the expectations are going forward. So the third level down that we had was $280 even. I was under the impression that the market would find some stability down at that level and have some kind of a bounce, give us a pattern that we could determine whether or not that was going to be the extent of the sell-off or whether the market was going to put in somewhat of a bearish pattern, leading us to believe in further downside activity. Well, obviously, the market opened right around that $280 level and just sold hard all day long. This is very telling, and it gives us a pretty good indication of what's to come, which brings into play the further downside horizontal lines that I have on the chart in green, $270.43 and $260.40. What these represent is the likely stopping point before we get any kind of a meaningful bounce higher for at least several days to a couple of weeks in the market. So the $270.43 level comes in just below the 50-period moving average. The market is likely to find some support there, but if we ended up selling slightly further, which would be right around another 30 S&P points below that, you can see here that we have the level identified as 267.40. That's going to be a very important level to the market, but you can also see that that coincides with a pretty good consolidation area, which in and of itself will be supportive of the market. So I have a couple of reasons why I can believe that that level down at 267 and change will be supportive of the market. No guarantee we get down that far on this run. However, we should get down to a minimum price target of $270.43. That doesn't mean we're going to go down there Monday or Tuesday, although we could, but it also doesn't necessarily mean markets move in a straight line. We're going to get sharp rallies and we're going to get sharp sell-offs in a market environment like this. Big swings in both directions is what we can expect going forward. When we see a heavy down day like this on volume, we saw 173 million shares. That's not enough volume to say it's a bottom, but it's certainly enough volume to say that it's not the end of a move, but it was a heavy sell day, indicating to me and indicating to, I'm sure, others that there's more downside coming to this market, and that's where the two green lines come into play. From where we are now, we could obviously go down pretty quickly next week, or we could begin to put in a bearish pattern, which is another option. So we can go sideways to higher, right? The market could find some stability this week and we could go sideways to higher, and then we can have another move down to one of these lower levels from that point. That's certainly a very distinct and highly probable set of conditions that we might find. That's unless we just go straight down again this coming week. Let's just assume for a second, and this is a probable scenario that I've mapped out. Let's assume for a second that we hit one of these green lines being our initial downside target. From that point, I will be expecting a pretty sharp rally to retrace somewhere in the neighborhood of about 35 to 50% of this move. So let's say we hit this line at some point, whether it's this week or it takes another couple of weeks to hit. Let's just assume that takes place. It could put us into, let's say, mid to late January. At that point, I would be expecting the market to rally for, let's just say, 3 to maybe 5 weeks from that point. That'll give the market enough time to make everybody believe that the sell-off is over and that we're going to make new highs yet again. Now, I'm not suggesting we can't or won't make new highs, but the cycles that I have mapped out and the way that I have this market going is that if we do hit one of these downside targets before finding major stability in this market, then the likely scenario is that we would bounce off those levels for a while, maybe 3 to 5 weeks, and then we would have another leg down, and that leg could ensue either in late February or sometime in March, extending the correction in this market. Now, today, this is somewhat hypothesized, and if in fact it begins to play out in the manner in which I just explained, we'll certainly have further downside targets. However, at this point in time, I don't see a downside target beyond 267.40. So we'll see what happens this coming week and what the market is telling us day by day, whether we put in a bearish pattern or we continue down to one of those two lower target levels. Here's the IWM, and the IWM, as you know, is my favorite market-leading indicator on the up and the downside. And the IWM, along with the transports, which we'll get to in a moment, the IWM was certainly telling us something along with the transports while the market, meaning the S&P 500, hadn't yet really cracked to the downside. So we did have some signals from the IWM and the transports first, even the transports this time, more so than the IWM. The transports were certainly melting away before and harder than the IWM was. But as you can see, the IWM has already closed below its daily 50-period moving average. That's the blue sloping trend line. As compared to the spider, you can see here that just on Friday alone is the first time in a while that we've breached on a daily chart closing basis the 20-period moving average, and we have yet to reach the 50-period moving average, but I do expect us to do so. Going back to the IWM, you can see the weakness here because we were already below the 20 and now we've closed below the 50. And what are we coming up to from the upside to the downside? We're coming right up to that upsloping trend line, and I'll draw it in from the monthly chart or take a look from the monthly chart. This is the trend line that is really the line in the sand. If we close below this trend line on a monthly chart closing basis, this will have been a failed breakout and more downside, and could be significant, could be in the cards. So I will be watching this towards the end or at the end of January. It's a long way off to find out where we close the month of January, whether it's above or below this upsloping trend line. And you can see this takes place from October 31, that's the close of October, linking together the lows, and you can see how the market has respected this trend line for a very long time. Here, 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 and then it found resistance right in here and resistance all the way up, and we finally started closing above this trend line just recently. Really, the first time we closed markedly above this trend line was in September of 2017, and we haven't closed below that trend line since. So January, or any month closing below that trend line, is going to be very, very important to the IWM, or the Russell 2000 index. Before we move on to the transports, I want to circle back to the spider chart one more time. This is the hourly chart, and what I want to point out, which is extremely important, is all the time that the spiders spent, or the S&P 500 spent, making this bearish consolidation pattern, and this is generally telling us that lower prices are coming. The bearish pattern consolidated for 21 hours or 21 candles before breaking down. So playing Monday morning quarterback, we can see why now that the $280 level was less significant than we originally discussed. The market consolidated over that level for 21 candles. That number 21 is extremely important. I talk about numbers in depth and which numbers are very important to charts in my course at lazyeMinitrader.com. So if you want to learn more about the importance of certain numbers and how they have an impact on markets and the charts, then come over to check out lazyeMinitrader.com and learn how you can use these numbers to your advantage on the charts. So I just find it very, very interesting and quite fascinating that we consolidated for exactly 21 candles, 21 bars, 21 hours, however you want to look at it, before breaking down. So what we had was a bearish pattern that looks like this. We had a down move, we went sideways for 21 candles, and then the market opened up down on Friday and continued lower. And not that it's an exact symmetrical move, but you can see here that certain symmetries existed before we really broke down at the end of the day. But there was a lot of symmetry developing here from the highs through the consolidation phase, and then in the middle of the afternoon, we found some support temporarily at what I would call a symmetrical level before breaking down farther to the 200-hour moving average. So I just thought that was interesting information that I wanted to bring to your attention. Now we're looking at the DJT, which is the Dow Jones Transportation Average, and this was the canary in the coal mine. This was the weaker index. We talked about it on the way down. We said that it was essentially giving us a signal. It was leading the market down. We certainly had weakness in the transports long before the other markets broke down. You can see we're already approaching the 50-period moving average, which is this blue upsloping trend line. And since the high, the transports have been down for 14 trading days to Friday's lows. Of course, not down every day, but it's 14 sessions or 14 days from the high to almost the 50-period moving average. There is a chance that this market finds some stability at the 50-period moving average, although it would potentially be a divergence, obviously, if the other markets continue down. But we'll have to see how that shapes up on Monday and beyond. Just to give a snapshot of the NASDAQ, we'll use the triple Qs. You can see where we cut through the 20-period moving average, the red upsloping trend line, like a hot knife through butter. And this market has more downside to come, like the other markets. At minimum, we'll get to the 50-period moving average. Just taking the math behind the markets, 157.88 would be a downside target that I could see the triple Qs coming to before any kind of a significant bounce if we continue to sell sooner than later. This 157.88 would coincide with the SPY targets on the downside that we discussed earlier. Looking over at the gold market, gold isn't in all that bad of shape still. We are still in an uptrend, although we did close below the 20-period moving average, and we also closed slightly below the 1338 level. We've been discussing 1338 in gold for quite some time. You can see the close officially at 1337.30. That's a close below, and that's the first sign or the first indication of more downside to come in the gold market. My math tells me that 1333, any daily chart close below 1333 would tend to accelerate the downside in the gold market. A close below 1333 would begin to bring the upside into question, and we would certainly favor the downside on a close below that number. But right now, from a technical chart perspective, there's really no damage done to the upside. There's no damage done to the uptrend just yet. Looking over at crude oil Crude oil was down about 1%, 74 cents. Not a big deal one way or the other. We're still above all the moving averages. This is still in a very strong uptrend. I can still see crude getting to the upside target that I've cited here, and I'm going to go over to the weekly chart to show you what that number is. And you can see here the 20-period moving average begins to slope downward into price. If we consolidate below that level, that's going to be the market's way of telling us that it's building energy, readying for another push higher. And my upside target on on crude oil is $73.78. That's what the math tells me. Could it be 74, even as high as 75? Of course it can, but the actual number that comes out from the calculator is $73.78. Very strong uptrend in crude oil. Today there was really no damage done. In fact, even though we had a down day across the board in just about everything, crude being down only 1% on a day when the market actually got smashed is an indication of relative strength in crude oil as it relates to the stock market, and that's a positive sign for crude oil. There are plenty of times where they'll throw out the baby with the bathwater, and crude oil will get hit very, very hard as the market gets hit on the same day at the same time. But that didn't happen today, and that tells me, at least for now, we have relative strength in crude oil. Relative strength in crude oil would favor more upside coming, as just discussed. Now, here's a chart of the 10-year Treasury note interest rate is at 2.854 right now. This has been the talk of the town over the last couple of days, and what you can see is a breakout to the upside in yields, meaning bond prices are going down. They trade inverse to yields. Lower bond prices means an increase in yields. Now, sporadically, over a long period of time, I've been discussing the fact that when and if, not if, but when, bond yields rise to a point where it begins to stifle the market, that will be trouble for the economy. And if there's trouble in the economy, there's trouble in the market, and vice versa. So what happens is, as rates go higher, it tends to put a ceiling on growth in the private sector. If money is more expensive to borrow, that means expansion slows down. That could mean manufacturing expansion, corporate expansion. That could also mean to the individuals like you and I, housing costs go up. That means that less people are able to buy homes, or you can buy less home because the borrowing costs go up. So a rise in interest rates, and this is just more fact than hypothesis, rising interest rates have a negative impact on the economy. And the market tends to be in front of all these things happening. So when the market sees these things happening, a one-day rise in interest rates doesn't stifle an economy. That's not the way it works. But a prolonged rise in interest rates, and interest rates staying high for a prolonged period of time, does have a negative impact on the economy. And if the market is sniffing that out ahead of time, that's where the market can end up taking prices down ahead of time, and also, or therefore, market capitalizations down at the same time, because the market is anticipating that there'll be less growth in the U.S. economy. And that's pretty much what the current storyline is telling us. However, when we do look at rates, you can see they're on a breakout, and there's certainly an uptrend on the daily chart. Let's take a look at the weekly chart. And on the weekly chart, you see a breakout. We're above all the moving averages. So this is a very, very bullish chart for rates. If you flip it around, it looks like the bond chart, so it's very bearish for bonds. But as we know, it's overbought. Markets certainly don't move in a straight line. And you can see here that if I draw this line up, you can see it's almost at a 90-degree angle from over the last several weeks. And that's unsustainable. Therefore, it's likely we're going to have to work off some of the overbought condition. However, when you look at the monthly chart, you see a very natural area where this market may want to trade to on the upside, meaning rates will continue going up till we get to about 3.3% on the 10-year. At that point, you will have maximum bullishness in interest rates in the media, maximum bearish in bond prices, which is the inverse of interest rates, We may see further selling in the stock market while interest rates are headed to that number, but that's at the point in which I would expect us to see interest rates stall on the upside and begin to pull back somewhat. You can also see market symmetry beginning to develop on the monthly chart. This is a long-term chart. So you see here's a low and here's a high. Then we pulled back and here's another low. And if we draw another line up to the high, you can see how these two lines, while not equidistant, they're not that far off from each other. And there is market symmetry at work. So I would think somewhere in between 3.3 potentially, and this would be a high number, but up to the 200 period moving average, somewhere in this neighborhood are where rates, if they continue higher, are likely to stall out, and we would see a reversal take place to work off some of the severely overbought condition that already exists in the bond market, or the interest rate market, I should say. We've discussed this periodically over time, and we're at that point now where we are seeing rates move up significantly, and therefore everything that we've discussed is actually beginning to play out as we've discussed it. So let's see what happens over the next few days. For now, this is everything I wanted to and intended to discuss tonight. We'll be back after Monday's session with another review, and we'll see what happened in the markets. But I'm going to give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.